Hi there, and welcome to Week 8's lecture of Finance, Financial Markets and Institutions. In this week's lecture, we're going to discuss the banking industry and why it's important in the context of a capitalist society and how the banking system creates wealth for these economies. So far in the module, as you know, we've covered the various regulatory aspects of the banking sector in general and how the likes of a potential regulator authorises firms and supervises firms from a risk point of view, and how conduct authorities look to regulate the behaviour of individuals within these firms. But in today's lecture, we're actually going to talk about the role of banks within the financial system, how they create wealth through the intermediation process. Then we're going to look at the different types of banking institutions, the various risks that banks face, and then finally finish off with the role of central banks within the financial services sector. But as noted before, we're going to start by talking about the banking sector from a capitalist point of view. Now, I really want you to do some external reading regarding the various economic states and economic models that are out there. But I put this up here as really kind of informal, a bit of a joke, so I'll let you pause the video and have a read of this, certainly the last one, which has a bit of a dig at capitalism. But to understand how the likes of these economic models work, there's a nice joke here regarding two cows, and you'll see the likes of socialism is if you have two cows, you'll give one to your neighbour. If it was communism, the state would take your two cows off you, but then provide you the milk. But then we can see the kind of traditional capitalism example, where you have two cows, you decide to sell one of them and buy a bull, so then you can use the cow and the bull to multiply your herd, to grow your economy, to create wealth, eventually sell them off and retire on the income. So that's the kind of concept of capitalism, trying to make the best of the resources you have to create and generate wealth. But I'll let you pause the video and have a read of these. If we look at where the likes of capitalism originated from, you may be very familiar with the name of Adam Smith, who came up with the concept of free market competition. I should add at this point, but not free from regulation, of course. If you can see from the definition there, we're talking about supplies being used for immediate consumption. And what you can see from the points underneath, in this context, we'd say that assets would also be used now, any sort of revenue set aside should be used now to consume, but also acknowledging that things that you have in the past can still be relevant for today. Like, for instance, clothes and furniture that you bought in the past are still useful today. This definition of capitalism has changed over the years, and if we fast forward to the 1990s, you can see a definition here, which really talks about the mere accumulation of wealth. Now, what on earth do we mean by accumulation of wealth? Well, you can just think of that from a capital point of view, where your own wealth starts increasing. Potentially you might make an investment for that wealth to grow. The ultimate idea behind this is that you use your current level of capital to create more capital. And this is kind of a good definition that banks do nowadays from an intermediary point of view. They use their current capital, customer deposits, to lend out to create more wealth. But this obviously doesn't have to be capital. If we look at normal business and manufacturing, this could be making the most of your machinery, of your stock. And under this definition, the likes of monopolies are a big no-no. The idea is that one person should not control the money supply because this doesn't create a level playing field. So in an open, free market, the market should come together via equilibrium to control the level of money supply and the generation of wealth across the market. So I do want you to go back through some of the older textbooks or various searches just to understand what we mean by capitalism and how it's developed over the number of years into what we know capitalism as of today. But how do we then go ahead and define the financial system within the capitalist system or economy? Well, ultimately, you can say it's an arena for financial instruments and the individuals and institutions to trade such instruments under the supervision of relevant regulators. So I like this definition, and to be fair, it kind of encapsulates a lot of elements of what a financial system is. But there's various concepts. You've got the formal system, which we're all very familiar with. We go to banks to put our deposits in, and we receive loans from the banks in a very structured and regulated way. But there's also the informal sort of financial system. This could be the likes of you lending money from your mate, but it could also be a whole informal industry. And there's some countries that do have an informal banking sector and an informal cash sector that they do most of their transactions with outside of their nation's banking system. And many countries in the past have tried to curb the informal banking sector and want most of the wealth to be within the banking sector. So examples you could potentially research on would be from India, who've had many struggles with the informal economy in the past. But ultimately, within a financial system, you have someone that needs money, people that demand money, and then you have people that supply money, that people save. So you've got your savers and you've got your borrowers, and they are your main market participants. And the financial system is really about allocating resources efficiently. How do you get the money from the people that have it, the surplus, to the demand? That's what the financial system ultimately is there to do, to allocate resources efficiently. There's other key facilities that the banking system or the financial system also does. You'll be very familiar with the first concept of the payments mechanisms. Essentially, how do we price goods and how do we pay for them? And what does that look like? Also, the concept of providing financial services. And we'll go on, I'll cover lots of these different types of financial services in the next series of lectures. Also, the financial system provides portfolio adjustment facilities, and we'll cover that shortly. And the last point is the key point, the intermediation between people that have surplus and the people that hold a deficit, allocating them resources efficiently. So we just first of all look at the payment mechanisms one. Now, this is just a large number of examples of payment mechanisms. You'll be very familiar with cash, debit cards, credit cards, checks, which are getting phased out in the UK, even the likes of gift vouchers. But from a commercial point of view, you can see that how payment mechanisms have started to change over the number of years. So electronic transfers, BACS, are becoming obviously very popular, very common nowadays, but in the past they didn't used to be. But now we also see the development of e-payments, potential payments through crypto assets. I'm not going to call them cryptocurrencies because ultimately the central governments don't recognise them as a currency yet. But you can see the various different ways of payments have changed over the years. Instead of just going cash in hand, there's many ways to make transactions nowadays. And for these payment mechanisms to be, I suppose, legitimised, then they really do have to be recognised by, in the UK in the case of the Bank of England, but if it's not the UK, it has to be recognised and legal by the central bank or the regulator in that country. The other concept of the financial system is the portfolio adjustment facilities. And this is just a fancy word of talking about the various products and instruments that are available for you as consumers, but also for commercial enterprises to use as well, such as your typical bank deposits that you're very familiar with. But we will go through a few of these concepts throughout the next series of lectures of how the financial system may create wealth by facilitating treasury bills from government debt, how they may facilitate equity, so ownership and capital structure from organisations' point of views. Then we've already kind of covered insurance, and that links to like life assurance and pensions. We briefly mentioned that when we talk about insurance as well. But there's various other products that the financial system has obviously created and generated in order to facilitate allocating resources efficiently between people that have money and people that do not. So if you want to put this on a diagram, this is one of the better diagrams, very simplistic, to show you what the intermediary process actually looks like. You have your ultimate lenders and your ultimate borrowers. Now we can first of all just ask, well, who on earth are these people or corporations? If we think, who are the lenders? Who are the people that lend out the money? Who are the people that have the money? Ultimately, these are the people that are savers. People that have capital sitting in their account and they want to make use of this capital. So ultimate lenders are your savers. And these could be governments that run a surplus as well. They could be firms that run a surplus. They could be individuals. Ultimate borrowers, who are they? Well, ultimate borrowers are also governments. But government debt, government borrow from investors. These could be individuals borrowing. And of course, they could be firms borrowing to invest in machinery. And the financial system and the intermediation process is to kind of avoid point one here, the direct lending. So think of the risks about direct lending. Is it easy to identify someone that's got money? Or if you have money, are you going to walk down Northumberland Street with some money in your hand, say who wants to borrow this, waving it at them, seeking out borrowers? So the direct sort of route doesn't really exist in conventional sense, but nowadays what we have seen with the development of technology and with the development of the likes of crowdfunding platforms, this is really starting to chip away at the intermediary process, because typically direct lending didn't exist until the likes of crowdfunding. Then you have route 2, which is through the markets, and this could be the capital markets or the money markets, and we will cover these in the next series of lectures. And these markets typically are wholesale borrowing and lending. And then point 3 is the intermediation process, and this would be the way through the banking sector. So lenders would put deposits within the financial institutions, banks, and the banks would then transform that and borrow it out to people that need it. But of course, the intermediaries, the banks themselves, do get involved in the money markets and capital markets to borrow and lend from the markets to increase their own wealth or to increase the amount of money they have to lend out to ultimate borrowers. So that's why you've got the dotted line interaction between the markets and the intermediaries, the banks. So just to kind of recap that diagram, the intermediation definition is the act of intervening for the purpose of bringing about a settlement. Obviously, the concept of bringing about a settlement is the name for the transaction between getting deposits and lending out and borrowing. So you've settled the money between the ultimate lender to the ultimate borrower. Or you can look at it another way, the fact that the intermediary has brought together the person that has the money to the person that needs the money. So any kind of definition along them lines will kind of suit what an intermediary does. They get the money from where it is to where it's needed to allocate resources efficiently. I mentioned before why you wouldn't do direct lending. Number 1, it is costly, it's inefficient, and it's risky. Why is it costly? Because you have to do all the search costs. You have to seek out I've got this money. You have to do all the research to say who needs the money. This could be a long, inefficient process. And riskiness is, if it's over the counter, is it regulated? Quite frankly, if you lend money directly to someone, you run the risk of that not being returned. So there could be a lot of credit risk involved. You'll have to do all the search costs. You'll have to do all the background checking of their credit risk and their trust that you'll get the money back. So these are all the kind of downsides from direct lending, is that it's too inefficient, costly exercise, and will you actually get the money back in the first place? Is it regulated? But again, as I noted before, the likes of the crowdfunding platforms have kind of stepped in here and have kind of been able to facilitate direct lending, but really obviously with a little fee there because they take a little bit of charge from the depositor, we'll say. The second route was lending via the markets, And this is really known as the secondary market, so the kind of buying and selling of products. So this would be a concept where the likes of an ultimate borrower, they may issue a bond which the surplus lender will buy off them, so the ultimate borrower receives the cash they need, and the person that had the surplus will then have a product or an income stream from the ultimate borrower. So this could be the likes of a bond, where the borrower would write the bond to say, I'll receive this cash from you and I'll pay you this interest over this period, and then return the cash back at the end of the bond. And we'll cover these in detail again when we cover the bond markets. This is obviously a bit more efficient than the direct lending approach, and it does reduce some of the search costs of this. However, if you are the ultimate borrower and you're issuing a product like a bond, you're still going to need some advice on how to do that. It still needs to be done in a regulatory environment. So typically, the commercial or investment banks will kind of step in to help you facilitate this in the first place. But as noted, the likes of lending through markets is done through the capital markets, through equity or debt, but also the money markets and the various products on that, which we'll discuss in future lectures. And typically, because these products that we're creating in this secondary market to buy or sell are regulated, then obviously this reduces the risk compared to the likes of direct lending. And the last approach, the approach which you'll be very familiar with, is the intermediation process through the banking sector. And this is very, very similar to open market operations, where the likes of an intermediary, the banking sector, will take deposits from the surplus providers, and then they will transform this deposit into a loan and lend it out to the ultimate borrowers who are seeking a loan for whatever purpose that might be, to obviously potentially improve their business or look to make an investment in new machinery and so on, to hopefully increase their efficiency and their wealth generation. And because the intermediary kind of pools all of the deposits in one place, everyone kind of knows who these intermediaries are and what their role are, therefore the search costs are reduced. The intermediary itself kind of assumes quite a lot of the credit risk from the depositor and from the borrower, and because of the large amount of surplus that's provided to the intermediaries, then they can create efficient, diverse portfolios to reduce risk even further. And as noted before, that they do transact with the markets themselves. So if they have excess surplus themselves, they can go into the markets to potentially lend that to other intermediaries to facilitate their intermediation process. But the key thing here is, certainly under classical economics, is that lending via intermediaries creates wealth. Basically, the banks receive lots of surplus cash. They hold it. That wouldn't be very useful. They receive this cash, they lend it out, that's what generates the wealth. They know, on average, how many people are going to withdraw their surplus. So that means they only need to hold back a certain amount, which we know as the reserve ratio. So banks will model it and understand that they only need to hold back a small proportion of this surplus, and then they can lend out the rest. And it's this lending process which is where the wealth creation happens. Because they create a loan, that loan returns an interest, which benefits the bank's wealth, of course. But what's the loan being used for? Well, the person that's getting the loan will say, if it's a organisation, they might have lent this loan to make their machinery more efficient, to make their business more efficient, to generate more profits for themselves, in order that they can pay back this loan and be more profitable in the future, to help the economy grow further and create additional wealth. If it's for individuals, this loan might be to buy property in the form of a mortgage. So an individual might have a small deposit, therefore they need the larger loan to enable them to buy the house for their own security. If people are buying houses, house prices increase, which again generates additional wealth, because you pay back the interest on the loan, but if the house price goes up in value, then more wealth is generated. But it all surrounds the level of this reserve ratio. So if the banks hold more cash in reserves, then that obviously slows down wealth creation. But if their reserve ratio is quite low, then this could create a lot of wealth generation, but it also runs the risk that the fact that people do cause a run on the bank and go, oh, the surplus holders need their cash back, then can they get access to that at the same time, all at the same time, if the bank doesn't store it? So this has to be carefully modelled and managed. But this also goes the same with the bank's deposits in central banks. So central banks might require a certain reserve ratio for the banks to store within the central bank, and if the central bank start changing this reserve ratio that they require, then this could impact the amount of wealth generation in the economy. So if the central bank increases their reserve ratio that banks must hold with them, that will kind of restrict the amount of lending the banks can do to the people that require loans. And that would really reduce money supply in the economy. Now, if we look at this from kind of the modern economy point of view, then the intermediation process, I've obviously used the word loan over and over, but that's what I'm really referring to. The beauty of the intermediary process is that the bank's asset is your liability. The bank's liability is your asset. So that's how they kind of transform it. So when you put a deposit into a bank, that's your asset because that's your cash. But from the bank, it's a liability because they owe you that back at some point if you take it back out. But that's where the banks can model or know when or if you'll take that money back out and at how much. But obviously on the lending side, the bank's assets is its loans portfolio, which is obviously a customer's liability. And if we put that into a diagram to make it a bit more visual, then this is kind of how the bank creates wealth. And it's through that transformation process of converting your asset into their liability and vice versa. And the fact that they charge interest on their assets, but the interest they pay out on deposits is typically a lot lower. So obviously this is where the banks start making their money because they charge more interest on their assets than they pay out on their liabilities, which increases the bank's profitability, which again is generating wealth because the banks generate more profit for themselves, then they can potentially lend out more. Obviously here I'm assuming no risk. Obviously we have to bear that in mind that it exists. But ultimately this is how the wealth creation process happens. Obviously this lending through intermediaries does depend on a lot of factors. I'll just note there, like the likes of no risk, but it also depends on a number of other considerations. Let's think about, first of all, the commercial considerations. The kind of borrowers, they will only borrow if they're confident. They will only borrow if they know it's going to make their business model more efficient. They're not going to borrow if they think it's going to impact their profitability. So commercial organisations, businesses, need to ensure that they remain profitable, that they manage their risk appropriately, i.e. they don't lend too much. Because if they lend too much, that could cause the business problems. And also the kind of regulatory aspects that commercial enterprises need to kind of remember as well. But in a capitalist society, in a wealth generation concept, it does surround this idea of confidence. If there's a lot of confidence and a lot of kind of good vibes, positivity in the market, then this is where wealth generation is more productive, it's better. If people are confident that people are spending money, then firms are willing to lend more, to provide these products that people want to buy. If everyone thinks the economy is going well, potential spending will increase, which again kind of drives business and then wants them to kind of expand, and to expand you need loans to do that potentially. But if confidence drops, people stop lending, people might just save more, and then if confidence is reduced, then it kind of stagnates the wealth creation process because no one wants to borrow because they're worried about future prospects. So when we start hitting the likes of recessions, this is where you see the likes of central governments impacting interest rates. So when everyone's confidence is reduced, where they start worrying about how much they have to spend, then potentially this is where central government, central banks step in and lower the likes of interest rates to kind of build confidence again, to get people thinking, oh, actually interest rates have gone down. I can now borrow at a lower rate, and that's going to help me save some money potentially. So therefore I can borrow at a lower rate to try and generate my wealth again. So this is potentially how the likes of central banks can alter interest rates and short-term interest rates to try and build up that confidence and build up that economy again. And if you want to see that on a diagram, then we have obviously the kind of supply and demand graphs that you may be very familiar with from your own economics backgrounds. But obviously the concept being if interest rates drop, the idea is it's being dropped to try and kickstart spending. People borrow at lower interest rates. If interest rates go up, people stop borrowing because it gets more expensive for them to do so. So if from a central bank point of view in this wealth creation process, then they have to manage it efficiently to try and get an equilibrium to ensure that economies grow well but don't grow too fast, because the likes of inflation would come into it, and inflation potentially chews away at cash deposits, and things start becoming more expensive for people to buy, and so on. So it's a bit of a balancing act to facilitate this wealth creation without letting interest rates and inflation get out of control. But for the economists watching this might be an avenue that you might want to explore in your own readings. But also from an individual bank point of view, obviously the bank knows how much wealth it has that it can distribute. Then they have to obviously price their products accordingly, because if they price it too expensive, i.e. their loans are too expensive, no one's going to lend from them. So obviously you need to look at kind of market rates and the amount of reserves they have when they price their loans, because the pricing of loans does impact the ability for people to pay them back, and if they can't pay them back, they're not going to borrow from that bank. But just to kind of finish off the lending through intermediations, I think the kind of key concept here, I've talked about allocating resources efficiently, but ultimately intermediaries can build up economies of scale. They can get large deposits, they can lend out large loans, they can diversify their own portfolios to reduce risk, they can lend to one another, they can lend to the markets quite efficiently in order to spread risk and diversify the risk across the financial system or across the intermediaries to lower the levels of risk. But this does obviously result in problems. Spreading risk could be a good thing, but if there's the likes of systematic risk, which we've seen during the financial crisis, or if there's a liquidity shock where the borrowing dries up across the markets, and this can obviously lead to what we've seen in the financial crisis. But also, if you've got economies of scale and banks get too big, then we run into the issues of too big to fail, too big to regulate, and then if banks are too big, they might monopolise themselves. And going back to what we said earlier about capitalism, monopolies are a no-no. So we don't want banks to create a monopoly, because they could set interest rates themselves, or if there's only a few banks in the market, then they may be reckless and charge higher interest rates, thus people will not borrow from them or be not being able to borrow from them. So obviously we want to make sure that if they do gain economies of scale, they don't create monopolies, because that would be detrimental, as they could be reckless and charge higher rates and no one will borrow, thus not creating wealth. But obviously from a consumer perspective, it's all about the concept of maturity transformation. This concept of maturity transformation and creating wealth is the fact that deposits typically are short term. You know, a cash deposit, you might put your money in, take it out, there's lots of payment transactions, direct debits, what have you. You know, cash deposits are quite short term. But loans, they're long term. Mortgages, you know, they're 25, 30, 40 years, depending on the product. So the banks need to obviously model this kind of maturity transformation. How do they transform the short-term surpluses into the long-term loans? And they know this and know how to do this maturity transformation due to the concept of the reserve ratio and modeling historic trends regarding the kind of cash withdrawals and how often that happens. And of course, if they have economies of scale and they have large deposits. I know I say deposits is short term, but there is an element of stickiness. I'll go on to talk about in the next part about banks and the fact that we don't change our bank accounts. We don't move between lenders. Therefore, some deposits are quite sticky and they'll always be there. Obviously, some saving products are locked. So another element of the intermediary process is the fact that banks can turn our short-term assets into their long-term assets. So our deposit, short-term, they can pool all them together and transform that into more long-term assets for themselves in issuing loans. And that concludes this part of how banks facilitate the intermediation process in a capitalist society, but we've also explored the types of direct lending, the lending via the markets, and this intermediation process. Hi there, and welcome to the second part of this lecture on the banking industry. So far we've looked at the role the banks play within the economy, and we've looked at the full intermediation process. In the second part, we're going to look at the different types of banking institutions, their levels of risk and how we define different types of risk. And we're also going to finish off by looking at the role of the central bank. Now what you can see on the screen here is a clip from a core textbook from the past, just to give you a sense of the scale of the various different institutions that we call banks. So you might walk down the likes of Northumberland High Street in Newcastle and you'll see various banking institutions and you'll just see them as a retail bank, and you may have a customer account with them, but you may also be aware that the likes of these banks also have very different roles. They have very large head offices, and you probably think, what on earth goes on in them? Well, typically these banks on the high street, all you see is their customer arm, but they will have a big element behind them of corporate banking, so dealing with their businesses. They may have investment banking arms where they provide advice and services to other large corporations. And they also may do their own proprietary trading. So they may be involved in trading activities using their own funds. But think about what else does your retail bank do? It provides a service, i.e. you can transfer money, you make online payments. You may have a share dealing account with them. You may have savings products, you may have debt products and the likes of mortgages. You might even use them for foreign exchange. So we may just call banks banks, but in the banking industry, banks are broken down into various different types. But a bank, or a brand if you want to call it, might do all the types of banking. So like HSBC, it is a retail bank, it is a corporate bank, it's an investment bank. It does share dealing, it does foreign exchange. So we say it's a financial institution, it's a bank. But if we actually break it down, it does cover a range of different banking services. But let's go through the definitions as per the textbook and the definitions we may be more familiar with personally. But do remember that one institution can do all of these various activities. So let's start with the retail bank. This is one that you'll be most familiar with. The purpose of a retail bank is to accept customer deposits, store customers' wealth, and then issue out loans to individuals that require borrowing, just in the intermediary process that we discussed earlier. Also, the retail bank will have the infrastructure in place to make the payment mechanisms, whether that be when you buy goods or services, or whether this be transferring money to various counterparts. But as you know, a retail bank doesn't just accept your customer deposits and lend you loans. There's various other things you may go to your bank for. This could be for share dealing. It could be you might have your insurance with your bank, foreign exchange. They might provide some wealth management advice to you. And if we look at the characteristics, these are typically your retail clients, your small clients. If you remember back to how the FCA classify clients, remember the first one was retail clients. Then typically, if you're a retail bank, then of course you would be really dealing with retail clients who require the higher levels of protection when it comes to selling products. I would like to note at this stage, when we're talking about banks, we are really referring to the kind of listed organisations, ones that are publicly listed and they have shareholders. But where you may be very familiar with different types of retail, well, I'm going to say banking, but they're not banks, institutions. So the likes of building societies also provide retail banking services. But a building society is very different to a bank. The first one is definitely its ownership structure. So shareholders don't exist. If you're someone that has a building society account, then you're a member, and as a member you own part of this building society. So you may see the adverts on the TV, we're on your side, we're owned by our members, not shareholders. And this sort of marketing campaign you may see post-crisis to build trust. So the first one is definitely their ownership structure. But the other major one is their business model. Building societies traditionally really do just accept deposits and lend out on real estate or mortgages. And because of this, they typically have less interactions with the money markets, which we will cover in next week's lecture. And they won't do as much wholesale borrowing due to their restrictions, and they will rely heavily on their customer deposits to provide or to transform into loans. So the key differences are the ownership structure and the business structure. Next is what's known as commercial banking. So this is typically a higher level from retail banking. This is where banks provide services typically to businesses. So as we move up the client scale, this would be typically towards your professional clients. And what you can see, the kind of actions that a corporate bank would do is this might be to provide business banking, foreign exchange risk management for organisations that are making transactions overseas for trading purposes. They may also provide certain derivatives products to business for risk management purposes, and also guarantees or letters of credit. So when firms are making transactions overseas, then potentially they may do activities which involve dealing with other banks and providing letters of credit to say that you have the ability to pay for whatever overseas transaction or amount is. But also these guarantees could be if the company was to default, the bank would end up paying for the goods and services. And this is a product or mechanism to help facilitate overseas trading when two businesses might not know each other or their credit history. But again, they will have supplementary services. This is where they might also have services that are very similar to the retail banking. So as we just mentioned before, the likes of private wealth management banking, stockbroking, pension advice, foreign exchange advice. So again, these supplementary services are quite similar to what we've seen from the retail bank, but typically done obviously to the professional clients who need a lower level of protection. Next, we have wholesale banks, or what we typically call investment banks. And this first one is investment banking from a corporate side. So this is again dealing with organizations and businesses. So these could be again your professional clients, or even sometimes your elective counterparties. And corporate banking or investment banking is typically actually stuff like advice. It's not taking deposits and lending loans. That's what commercial banking does. Wholesale or investment banking is all about underwriting, whether it be insurance, merger and acquisition advice, and basically anything that is a fee-based approach. So an organisation will go to the bank, the investment bank, to ask for their advice or for them to potentially facilitate large lending or pooled lending in the case of larger projects. And you would certainly go to your investment bank if you are dealing with large levels of international trade. But also wholesale banking or investment banking has a whole market activity side to it. And this is typically where the investment bank may do this on a client's behalf, or it may do it with their own wealth, which is what's known as proprietary trading. So the investment bank's market activity could be where they're trading with their own money in the derivatives markets. That could be speculation or hedging. This could be their brokering between transactions between customers and the likes of the stock market. This also could be where you act as a underwriter for a IPO. So when an organisation wants to list on the stock exchange, what may happen is their bank or their investment bank may buy all of the equity in the company, and then they sell the equity onto the market via the exchange. So they underwrite the whole listing in the IPO process, which we'll cover in a few weeks' time on this module. And this is what's known as the market maker, where they buy all the equity from the company and sell it to the market. So this is really anything to do with the whole trading side and market activities, whether that be for speculation, hedging, or listing. And again, this would be typically with your eligible counterparts or professional clients. What I'd recommend is that you grab a hold of the core textbook and read up on the various definitions of these types of banking institutions. But do remember, one bank like HSBC will be a retail bank, a commercial bank, and an investment bank with both market activities and commercial activities. Let's just now have a look at kind of the banking landscape from a UK point of view. Now, this is not the whole picture, but it's not far off. So if we go back at least 6 or 7 years ago, if we look at the landscape in the UK, then I'm pretty sure you might recognise the majority of these organisations or logos. And typically when we talk about banking in a market, we typically call the clearing banks and the medium challengers. And then following this, we have the niche or the fintech sector. But what your clearing banks are pretty much the ones where the majority of the wealth is, where most people have their accounts with, and if you're a business, more likely you're going to deal with them for your commercial banking. And I'm guessing the majority of the people watching this recording will have most of their money in the banks on the left hand side. I've put Nationwide Building Society in the middle. This is because it's obviously a bit different. It is a building society, as mentioned before. It has a different business model and ownership structure. But Nationwide is quite unique for the building societies in the fact it can compete with the clearing banks. So the majority or the levels of assets this building society has tends to be typically larger than the medium challengers, but still quite behind the banks. But then you've got the medium challengers over on the right hand side. So this is where in the early 2000s the supermarkets got involved. You're wondering, why did the supermarkets become a bank? Well, the supermarkets kind of realised they had a pretty decent cash flow. And where do you want to store that cash flow? Instead of dealing with a bank, you might want to have a bank yourself. Typically, when they went into banking, they did a joint venture. So they will have potentially done a joint venture with one of the clearing banks to get the legal infrastructure, the expertise and the knowledge, and eventually kind of wean off the collaborative ventureship to become their own bank. And that's how they potentially transformed from being a supermarket to also having a banking arm through joint ventures. But this is really what the banking sector kind of looked like. If we look at that from a kind of total assets point of view, then you can see the scale of the clearing banks on the left-hand side of total assets, meaning kind of customer deposits, we'll say, that are, to oversimplify it. But you can see the scale of the clearing banks. Obviously, you've got Nationwide there, which has got a bigger asset base than the medium-sized challengers. But you can kind of see how highly concentrated the UK banking sector was. And to be fair, it still is. You still have the kind of big five banks here, with Nationwide being in the middle, then all the kind of challenger banks. But this graph doesn't even include, well, most of the building societies network. So in the UK, just off the top of my head, there's at least 90 building societies. You've got Newcastle Building Society here in Newcastle. The other ones are being Leeds Building Society and Yorkshire Building Society. They're obviously not on this chart, and they do obviously have a large asset base, but compared to the likes of Nationwide, it's still very small, with Nationwide being the largest building society by a long way. But let's kind of like fast forward to 2019 or this year, and we can see the kind of banking landscape is really shifted. Now again, this is a little bit of an over-exaggeration, but you can get the idea. You've still got your clearing banks, you've still got your medium challengers. We've seen recently troubles from IT point of view, from Tesco Bank, from Metro Bank, but ultimately you've still got the big clearing banks. They did take a rep damage hit post financial crisis, but we've seen from 2014 they might took a reputational damage hit, but their assets were still huge in 2014. And they're probably still similar size today. I'd urge everyone to go to Bloomberg and download the relevant data regarding asset size and see how their balance sheets have transformed over the last years. Highly recommend you doing that. But what we have seen over the last 5 years is the emergence of the fintech sector. And potentially the younger generation will have seen this more than the older generation. So you may be very familiar with Monzo and Revolut being the kind of two big ones with their technology and their apps. So Monzo, very good for retail products. Revolut, very good for their international transactions and foreign exchange rates. But you also have other things like Atom Bank, which is based actually in Durham. And these are just kind of online only banks. And that's the major transformation we've seen. And we've had other developments from the kind of specialist lenders and the specialist advisors that have appeared, again, most being online based. We've also seen a large increase in kind of online wallets and payment mechanisms through various different payment channels. So instead of using the kind of legacy systems from a bank to do international transactions, we've seen all these payment systems appear. But having said all that and how the kind of landscape has changed quite significantly from a technology point of view, I can still suggest that most people watching this, your money will be with the clearing banks in the top left-hand corner still. You may use various products from the fintech sector. You may use online organisations for transactions overseas, what have you, but most of your wealth will still be in the top left-hand corner, and that's ultimately been identified as kind of one of the challenges for the banking sector and how it evolves. So we'll know who Andrew Bradley is. He's now the head of the Bank of England, as the governor of the Bank of England, but prior to this he was actually head of the FCA. And in their strategic review of the retail sector in the UK in 2018, this was highlighted, was the fact that clearing banks still have kind of a captive audience. We don't change our bank account. This kind of steeped in, I suppose, kind of tradition really. People don't switch their bank account. They typically have their bank account that their parents set up. They might change if they get a student account, but then they'll probably stay with that student account and then obviously develop onto a normal account and stay with that bank for the rest of their life. And that's just because kind of we don't switch. It's a bit of a faff. We don't like dealing with changing on direct debits, what have you. So that's just a challenge for the banking sector, and it always has been. Even with the 5-day switching service and the incentives to switch, we still really don't do it. Obviously, the challenger banks, the fintech sector, they've come in with great new technology, made things faster and cheaper for the consumer. But the problem is we just use their product, and that's it. We transfer money in from our clearing bank to, say Monzo. We use Monzo for their app and for budgeting, but we don't have all of our wealth with Monzo. We have just a very small proportion. Thus, they can't cross-sell because they've only got one product. And if they don't charge fees for that one product, then really it doesn't matter how many deposits they get. They can't cross-sell you anything, and they're only making a small amount off their fees, which will cover obviously the original setup cost in the first place. So this is identified as one of the big problems for the fintech sector, is we don't switch bank accounts and they can't cross-sell. So how are they going to be profitable in the long run? Just like the challenger banks and the clearing banks. Despite the clearing banks having really legacy issues when it comes to IT, but these issues haven't really impacted the amount of customer deposits. We've seen IT issues with the banks. We've seen people not having access to certain bank accounts or transactions failing because of their legacy IT systems. We've seen banks getting hacked. But despite these legacy problems, we still don't switch. To help combat this and potentially try to distribute the wealth across the banking sector rather than having to be very highly concentrated, the regulators in the UK have tried to develop kind of incentives and lower regulations. So they call it a sandbox. So the likes of the fintech sector can go play in their little sandbox where they'll try to grow and develop, and they'll have less regulation on. And there's been obviously encouragements from various government incentives and initiatives to try and improve the use of IT in general within the banking sector and try to incentivise smaller firms to become obviously larger and gain more prominence within the banking sector. So now let's look at the various types of risks that banks face. Now there's obviously a long list here. I'm only going to do a very surface level coverage of them, and these risks are not in isolation. So one risk will lead to another, which will lead to another. And there's things on there that we haven't covered, like systemic risk. To put into perspective, for the finance and investment management students, next year you'll have 2 full modules covering at least the first 7 risks there. So we will have 2 modules which will go into a deep dive on these risks, what it is, how it's measured and how it's managed. But for this module, really we're just doing a very surface overview of, quite frankly, defining what this risk is and how it potentially may be managed if required. But as you can see there in the red, they are not mutually exclusive. Credit risk, people defaulting, could lead to the bank running out of money in the form of liquidity risk. Foreign exchange risk could arise from a sovereign debt default. So they tend to be heavily interlinked one way or the other. So let's start with credit risk, and I think this is one that most people are pretty familiar with. This is ultimately people defaulting. So if you issue a loan and they don't pay that loan back, that's what's known as default. That's credit risk. So it could be from a consumer point of view, where you lend a loan to an individual, they don't pay it back. But it also could be with a counterparty. If you are to lend money to other banks overnight through the money markets, again, what we'll cover next week, then if they don't pay you back, that's the counterparty defaulting. You'll be very familiar with credit rating agencies that rate individuals and organisations on the likelihood of them defaulting. And typically, if individuals or firms have a lower credit rating or a poor credit history, then typically on a loan you'd be charged more. Now, you're probably thinking, if you charge someone more that can't afford it in the first place or likely to default, why would you do that? Well, firstly, you have to compensate yourself for the level of risk you're taking, because you're lending to them knowing they could default. Therefore, you want to take or you want to be rewarded for that. But also, it might disincentivize the customer from actually lending from you in the first place, which obviously means you're not potentially returning any profit from that loan that doesn't get issued, but at the same time, you're protecting yourself from actually not getting the loan back in the first place. So that's credit risk. Interest rate risk. This is, well, simply the risk of interest rates changing and whether that impacts you as the lender or the consumer. So say you issue a fixed rate mortgage at 5% as the bank, so you're receiving 5% fixed, but then interest rates go up in the market to 10%. Okay, this is really over exaggerated and probably would never happen in practice, but you as the bank would still only receive 5% on that interest, when there's opportunity cost there. When in the market, if you issue a new loan, you can receive 10. For a consumer, then this could be just if you're on a variable product and interest rates change, and if interest rates go up substantially, so you were not on a fixed rate and you were on a variable tracker and interest rates did go up at 10%, then this could mean for the consumer, could you actually afford your loan at this new interest rate? And then you potentially could default, which leads to the likes of credit risk. Typically, interest rate risk for the bank arises from what's known as yield curve risk. We'll cover yield curves and yield curve theory when we do the bond lecture, and typically it arises from something called basis risk as well, and this is the small incremental changes in products that have very similar characteristics and priced very similarly, like products on the money market, but there might be small discrepancies between the level of interest rates charged, and this can potentially impact your kind of cash flow if the basis risk or yield curves change significantly. Then the level of income and your projected cash flows could change significantly. But also, if interest rates change, then this will impact the value of your assets. So if interest rates go up, the relationship is bond prices go down. So if you're having a portfolio full of bonds that you're holding on your balance sheet, if interest rates go up, then the bond values go down, therefore your assets on your balance sheet shrink. So therefore the size of your bank goes down. So these are the kind of concepts we might cover later on when we go through the bond lecture, but certainly for next year for FIM students we cover that in interest rate risk. So it's not just kind of cash flow, it's also value of the balance sheet based on how asset values change when interest rates. We also then have the likes of liquidity risk. The easiest definition for this is you run out of money, you run out of cash. So if you have a bill to pay or an interest rate interest payment to pay tomorrow, but you don't have any cash, therefore you run out of liquidity. How do you do it? Liquidity risk could arise from market liquidity. So banks typically lend overnight or over short periods on the wholesale money markets. Do they have access to the money markets? Is there enough liquidity in the market for them to borrow overnight from other banks? What we're seeing during the financial crisis is the money market did dry up or become more expensive. And that also links back to the LIBOR rigging scandal we were discussing a few weeks ago. So if you can't have access to market liquidity, then that might impact your cash flow as a bank. Also, if interest rates change and your income payments from your customers changes, then your forecasted cash flows might change substantially, which again could arise in liquidity risk. If people are worried about your bank and in the safety of your bank, then you might see what's known as a run on the bank, just like we've seen from Northern Rock, where everyone queued outside to take their money out. And if you have withdrawals on a large scale, that could lead you to have liquidity problems. Runs on the bank these days are typically done online. So obviously people do online banking, can make substantial withdrawals online very quickly. And how do you manage that? So liquidity risk can arise, as I said, from the markets, but it can also arise from your customers. If you do face liquidity risk, there is some remedies you could potentially observe to try and combat this. So if you face a shortage in cash flow from your consumers or from people paying back loans, what have you, then potentially you can borrow from other banks using the money markets. But as I've just noted, potentially you may also face issues within the money market itself. Another option would be to sell off some of your loan portfolio. So if you have assets, then you potentially could sell off your loan portfolio and transform that into cash. So if you've got a portfolio of mortgages, then you could potentially sell this to another counterparty in return for cash in the form of liquidity. It's not just loans though, there's various different financial assets that you may have as a bank that you could potentially sell off. But obviously going back to the intermediation process, your assets are other people's liabilities. So if you're selling off your assets, you're selling off someone's liabilities to you, therefore you're selling off your future income payments to get immediate cash. So you got to think as a business model, is that appropriate? And then lastly, you can borrow from the lender of the last resort, which is typically the central bank within that market or that country. And this is done typically by what's known as repurchase agreements, where you'd sell the central bank some very safe assets of your own, they'd provide liquidity, and then in the repurchase agreement, you reverse the transaction, so you buy these safe products back in return for more cash or an extra payment. So if you do face liquidity problems, there is 4 potential remedies of borrowing from other banks, selling off some of your assets, whether that be a loan portfolio or other securities. Then lastly, going to the lender of last resort, the central bank. And the last time we've seen this on the whole scale, again, was Northern Rock. They went to the Bank of England and asked for a repurchase agreement when they were facing their own liquidity problems because they couldn't borrow from the money markets because market liquidity. And this is where the Bank of England at the time turned around to Northern Rock and said, you don't have any safe assets for us to buy, therefore we really can't do a repurchase agreement. And this is when the media got a hold of this knowledge, disseminated this widely, which caused the run on the banks. We also have foreign exchange rate risk. FX risk is, as you can imagine, the change in the price of one currency relative to another currency. Foreign exchange risk can arise from 3 sources, typically known as translation. Translation being when you have to convert your assets from one currency to another for, I don't know, say if you're producing your annual reports and you have assets sitting in another country, then they'll be priced in that potential currency. If that currency value is relatively low at the moment, when you translate it into your host country's currency, it may show that your assets are actually rather low in value because of the FX risk. You've got transaction risk. So this is obviously making overseas transactions or receiving income payments from overseas. Then if you haven't hedged your foreign exchange, you'll have to take the price when the transaction takes place. And if one currency or your host currency is much lower, then when you receive income from overseas, it'll be much lower than you expected. But then you also have something known as economic exposure. And this is just more an economics concept, in the fact that if economics in one country can result in your customers potentially leaving you and going to that country. So if the economic indicators, say interest rates in the US, are higher than in the UK, your customers might want to go and save in American banks because they know they'll get a higher interest rate than saving in a UK bank. So potentially economic factors may force the likes of your commercial or eligible counterparties to deal in other countries rather than your own, because their economic indicators are more favourable. We also have something called market risk, and this is kind of split down to two factors. It could be what's known as systematic risk, where you have price movements of assets based on macroeconomic factors. So basically all prices move in the same direction because of something external. This is something that we seen last week when there was an announcement about a possible vaccine to help stop the coronavirus spreading. Now obviously this was an announcement by one company, but what we seen was an uplift in market confidence and potential uplift in future consumer spending and future potential demand when things return to normal. So this kind of economic uplift in utility resulted in all asset prices increasing, and that wasn't just equities, that was also the likes of oil, due to the expectation of increased demand for oil in the future. So something kind of external really impacted the whole market in a positive way in this case. But we've also seen it in negative elements. So if we go back to coronavirus, obviously the announcement of a government lockdown, that negatively impacted the whole stock market in many different countries. In the UK, when we've seen the Brexit vote, again, that's something external. That geopolitical issue resulted in the market systematically going down altogether. But there's also something on the flip side known as unsystematic risk or idiosyncratic risk, and this is where potentially prices of assets change due to isolated cases. So this could be something that impacts an individual company, like a lawsuit or the loss of a key member of staff. Then the asset price of that firm, whether that be its equity or debt, could drop significantly. So that's what's known as specific or unsystematic risk. Next we have operational risk, which is kind of a risk to people, processes and systems. So some of these typically could be outside your control as a bank. So for example, an external risk to a bank from an operational risk point of view is something as simple as a fire or an earthquake. Now this is going to cause a lot of operational issues if your building is put out of action for whatever reason. We have internal operational risk, so this could be risk of individuals, risk of your IT systems, but we also have the likes of external risks such as fire, floods, war. So operational risk covers a large list of potential internal and external threats. And obviously this could also link back to financial crime and criminal activity impacting your financial institution. So operational risk covers a vast amount of threats. There's also something called off-balance sheet risk. Now, typically banks, as they transformed their business models in the early 2000s, they went from a traditional banking model of receiving customer deposits and then lending out to a more lending overnight to lend to consumers, and that customer deposits shrank. But what we also seen was the development of what was known as the shadow banking sector. So the bank may have one of their other arms, such as their brokerage arm or their trading arm, where they would potentially shift money overnight onto these arms of their business, and potentially they may have used kind of payment mechanisms from off-balance sheet arms of their business. So essentially, when banks' annual reports were published, there was potentially a lot of things that weren't actually recorded because they were off-balance sheet. Typically, all your proprietary derivatives trading and your derivatives exposure, which was at the time over the counter, again was typically not recorded and off balance sheet. So the regulators and I suppose consumers had issues in trying to understand the level of leverage and how much debt the banks actually had prior to the financial crisis, because their derivatives transactions and their shadow banking arms may have hid the levels of leverage they had. And if a bank is highly leveraged, then they face a lot of credit risk, which was unknown to the market in many cases. We also have country and sovereign risk. I think the definition of these are pretty explicit. Country risk is, quite frankly, the risk of dealing in a certain country. So as you can imagine, some banks don't deal in some countries because their regulatory infrastructure may not be as strong, or there may be levels of civil unrest in certain countries, or geopolitical issues, meaning they wouldn't potentially want to bank there. And if they do bank there, then obviously any sort of local issue could impact the bank and the cash flows within that arm or branch of the bank. And sovereign risk really relates to the central government in that country, or if it's not central government's job, it would be the central bank's job. So any sort of government default or any default from a central bank in that country can really impact obviously the macroeconomic factors in that country, but then that could spill over to the banking sector if they lend to that government or central bank. So you may have seen historic cases of the Argentinian debt default, where the Argentinian government defaulted on its mainly US or US dollar debt, and this really impacted the Argentinian peso at the time and left the country in a real economic state regarding their macroeconomic factors, which really hit the Argentinian banking sector as the country went through a pretty deep recession. But like I said, the list just kind of keeps going on. And again, they're not mutually exclusive. Regulatory risk could obviously relate to any sort of regulatory change within a country. Typically, most Western banking sectors and some of the Asian banking sectors are part of what's known as the Basel Accords, which includes 27 jurisdictions, and they all kind of try to follow the same regulatory framework. But outside of this 27 jurisdictions, other countries are informed and try and follow Basel Accords as well to try and kind of ensure consistency at a global level. But there is still potentially some regulatory issues in specific countries that could impact your bank. And you've got reputational risk there, and that also falls under the likes of operational risk. And it is becoming more and more important nowadays. And there's a lot of money being spent on kind of PR to try and improve reputational damage. But as I say, pick up the core textbook and do have a read of the various types of risks that we have. And lastly, we're just going to look at the role of a central bank. Obviously, my example is made from a UK point of view, but central banks do differ around the world. But a typical definition for central banks is they're responsible for overseeing monetary policy, ultimately the setting of interest rates, to really influence the likes of inflation and economic growth within their country or jurisdiction. So typically the role of the central bank is really to create wealth or to kind of try and ensure the economy is in a state of growth and prosperity, to make the population of that country wealthier and more prosperous. But typically the role of a central bank, they deal with kind of the currency, the issuing of legal tender, notes and coins. They can control the amount of money that's within the banking sector through controlling of credit lines. They do act as the lender of last resort, as mentioned before, when it comes to liquidity, and typically they're the banker to the government in that country, and they typically hold the nation's gold reserves, or they manage and administer the levels of debt within the country. But in the UK, for instance, the central bank sets the interest rate, so they don't administer the level of government debt, because if they could set their own interest rate and issue debt on behalf of the government, then that would be a conflict of interest. So the likes of the UK, the Debt Management Office, the government is the one that issues debt, the likes of government debt, bonds, and that's based on the interest rate that's set by the central bank. And this was changed in 2000. Beforehand, it was the job of the Bank of England. But as you can imagine, if the Bank of England can set their interest rate and issue debt, that's a conflict of interest. But there's other ways, other than interest rate setting, how the central bank can influence the level of money in the economy and how it can help the banking sector. So we've got what's firstly known as open market operations, and this is simple. Well, you may see it on the TV or read about this as the concept of quantitative easing, where potentially the central bank can essentially print money to buy or sell debt from the banking sector. So if they wanted to do quantitative easing, then what the bank would do is it would buy product, it would print money, it would make new money to buy debt from the banks, which means they buy the debt from the banks, which gives the banks cash, therefore the banks can then lend. On the flip side, they could want to control money supply by decreasing it by selling debt. And if it's selling debt, then the banks are the ones buying it, so the banks give the central bank money, which means the banks are holding debt which gets an interest payment, but then it means they've got less cash to lend out to the economy. They also have what's known as discount windows, where they can potentially change the interest rates for short-term borrowing. So if they want to increase money supply, they would obviously lower their own overnight rates. So if they lower the overnight rates, then banks are more likely to lend from them to increase their supply of cash so they can lend out to get the economy going. But alternatively, if the bank wants to constrict the amount of cash available, then they'll put their own interest rates up, thus the banks will not lend from the central bank. And then lastly, we covered earlier on the retention ratio. Ultimately, the Bank of England or the central banks have their own retention ratio. If they want the banks to lend more to consumers, they will lower their reserve requirements, so banks wouldn't need to hold as much money in the central bank, and if that essentially would free up cash for the banks to lend out. But on the flip side, if economic times are difficult, then they might increase reserve ratios from a risk point of view, which means the banks would be unable to lend because they have to hold more with the likes of the central bank. So there's various different tools the central banks can do, as well as set interest rates to influence money supply and the available money within the banking sector. So again, pick up the core textbook and have a read regarding the role of the central bank. This really concludes this lecture. So within the banking seminar, at least ahead of it, we're going to have a look at the likes of Northern Rock, and this was an example of a failed institution during the financial crisis. So read the case study. If you're not too keen on reading, then there's various YouTube videos from the news. There's loads of documentaries online about what actually happened in Northern Rock, because Northern Rock covers a range of the risks we've discussed in the second half of this lecture, and it shows you how the intermediation process really broke down. So we've covered a lot in this lecture, so do pick up your core textbook online, have a read of the various types of banking institutions, the definitions, what they do, and look up the various types of risks they face. I look forward to seeing you in the seminar. Thank you.